Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 6th of March, 2015, and the market's closed with some losses here this week. S&P 500 lost 1.5%, Nasdaq down about 1%, Russell 2000 a little more than 1%. The financials were only down 0.5%, same with semiconductors, but those columns obviously are in the red for the month to date, as this was the beginning of a new month. Oil gained a little bit of ground back, but still looking ugly. And the interest rate sensitive Russell IYR, which is the commercial real estate index, lost 3.4% on the heels of bonds losing 4.6% for the week, and the dollar soared. And Biotechs added to their gains a little bit for the week as well, so they continue to be the strongest group out there. For coming into this week, we were cautious on the market as it was below the 5-day moving average, and it looked like perhaps we were going to try to recover here on Monday with that strong close, but it gapped lower on Tuesday and stayed below the declining volume 5-day moving average. So as I was telling subscribers all week, we simply cannot trust rally attempts while we have a market below a declining 5-day moving average, and that kept people out of a lot of trouble. And here on the 30-minute time frame, you can see that we're getting down to some important levels here. This is where we had that prior gap and some highs here from early February. Looking at a 65-minute time frame, we can see that this is really the bigger band of prior resistance, really all the way from 206 up to about 207. So we've got a couple of intermediate term levels below that, but we also have the 50-day moving average, which is this market is coming down towards quickly, also at 206. So 206 is clearly an important level, and if we look at the year-to-date volume weighted average price, it's at about 205. So it seems like 206 should be a level of support, if we get down towards there, but there's no advantage to purchasing on weakness. I think everyone can agree that that's the case, especially here today. We saw that this market started out in the gap lower, tried to recover a little bit, but broke below daily S2 and that volume weighted average price, and just stayed weak throughout the entire session. So looking at where we are for for the short term, we just had a pretty good little drop in here. So on Monday, perhaps we get a rally up towards this early next week, not necessarily Monday, but perhaps we get a rally up towards 209.25 to 209.75. This prior band of support is likely to become resistance. Doesn't mean you sell short there. It means you look for the opportunities for shorter term time frames to short if it backs away from that level. So we're not trying to predict, we're anticipating where the potential change would occur, and shorting as the market's down this low seems like probably a bad idea, but maybe we get a gap lower on Monday too, down towards that 206 level. Again, we have to look at this market right now on the intermediate term time frame is guilty till proven innocent. Clearly, longer term trend is still higher here, but again, this has been just a massive rally here off of those 2009 lows. So, at some point we're going to experience a deeper pullback. If this is the beginning of it, I'm not going to tell you right now. I'll tell you well after the fact. But for now, it does tell us that we need to treat this market very cautiously. The Nasdaq broke below their important level of support at 108. That's the level we identified last week. We were talking about these markets showing signs of fatigue, but not quite ready to break down yet. But if they broke below these key levels, that a deeper pullback was likely to ensue. Now for the Nasdaq, we've got this prior peak over here at about 106.25. We're trying to stabilize at that 20-day moving average, which is rising. But again, moving averages aren't a reason to purchase. Certainly the people who bought on Wednesday at the 20-day moving average on the SPY recognize that unless they got out quickly. And again, it's a reference point. It's a reason to look at the market on a closer level. If we take a look at, the 20-day moving average was at about 209.25 on Wednesday. And if we look at the action at 209.25, yes, it did bounce from there, but we were below a declining 5-day moving average, which meant don't trust the rally attempts. So back to the Nasdaq, I think that we're obviously also in corrective mode here as well, and that now that this level has been broken, that what we're going to look for, I think, is that this prior support, basically from 108 to about 108.25, is likely to become resistance. So if we get rallies up towards that level and then start to back away, it's likely that it would provide a good intermediate term short opportunity. We could take a a look at the Fibonacci here as well and see that, a 38% retracement would take us all the way down to that 106 level. So perhaps 106 is where we get at least a test of next week. For the Russell 2000, this prior peak from December is now being tested, and resistance broken tends to act as support, but it doesn't mean buy there. It means look at the action on a shorter term time frame to see if there's evidence that the buyers are in fact gaining control. And when we look at the 10-minute time frame, we can say no, the buyers are not gaining control here. We're below a declining 5-day moving average. We broke an important little band of support in here, and it looks like this market is likely to now find resistance up near about 121.75 to 122. We broke this trend line. We spoke about that last week, about this representing the essence of trend really right here. And we broke that trend line and then saw a 5-day moving average head lower with lower highs and lower lows below it. So we are guilty till proven innocent on the intermediate term time frame. Maybe we drop all the way down towards this 120 level where we had seen this prior little band of resistance and the 50-day moving average. So those are certainly levels that look like they're obtainable next week. So don't be in a hurry to get involved on the long side until we see actual signs of support and that the buyers come back in and regain control. Now, the semiconductors, we've got what's been an important little area here between 56.25 and 56.75. We had resistance there late last year, and then earlier, mid-February, that is. We're coming down and testing it. We do still have a rising 20-day moving average, so perhaps we find support there, but when we look at a shorter term time frame, there is zero evidence of it. In fact, when we look at this 30-minute time frame, we can see that we broke below this first level and then dropped below this next level here at 57-ish, and now it looks like we're likely to head down towards at least $56 a share. We've got this trend line that we can draw in here that has been broken today as well. So breaking a trend line doesn't mean the trend has changed. The only thing that tells us trend has changed is a lower high and a lower low, and we do have that below a declining 5-day moving average, so you have to look at it as guilty till proven innocent and likely to continue to bleed off. If things change, then that's what I update every single day for subscribers at Alpha Trends. The financials, we were looking at this group as saying 2410 to 2420 is really the key level, and we have held that so far, and I would say I guess 2410 to 2420 is the key level that this market needs to hold. What we've seen recently in here too is on this daily time frame, we've seen a couple of attempts to break beyond this little resistance. Now today we gapped higher, or we didn't gap higher, I'm sorry, we ran higher initially, and if you got involved early on, great, but once it broke below that volume weighted average price and broke this little lower high, this little lower low, that's where the sellers regained control, and we came all the way back down, exactly down to daily S2, and we're looking at a market here, the financials, that are really more neutral than anything. I think that 24 to 24 and a dime really is the key level. If we can continue to hold above that, perhaps the financials do not continue lower, but right now there's just no reason to be aggressively long or short in that market. Shares of Apple, we were talking about, they were looking fatigued, and we came into the market this week below the 5-day moving average. The 5-day moving average continued to hold this market hostage. We saw that the 5-day moving average, we got above it today, but the direction of the 5-day moving average was lower. And you have to look at Apple and think, if good news, so-called good news, being added to the Dow, it doesn't change anything at the company, obviously, but it changes maybe the nature of the people who will own Apple, that is the funds in that. But if that can't make it go higher, then there might be a bigger issue with Apple. And as we were saying last week, it would need to get back at least above this little area in order and hold above for it to become a purchase once again. It stayed below that, so there was no reason to be a buyer of Apple. There's still no reason to be a buyer of Apple, certainly not, especially not when you see that the market gaps up like it did today, and then early on, if you were were a day trader and buying as it got back above the volume weighted average price with a stock below here, and then trailing your stop up and maybe getting stopped out over here, that's fine for a long trade. But once it failed underneath that volume weighted average price, it just continued to see pressure throughout the day, closing pretty much near the lows. So where is support for the for shares of Apple? Well, so far it's closed 2 days in a row below that 20-day moving average, and we've had a heck of a rally here recently, so some deeper pullback shouldn't come as a surprise in here. If we take a look at Fibonacci off of the lows from mid-January to the recent highs here, a 38.2% retracement gets us down to 123-ish, and then we can take a look at that on the daily time frame, the year-to-date range. We've got a 50% retracement would bring us all the way down to 120-ish, and we would likely encounter a 50-day moving average in that area as well as prior resistance. So that, perhaps we're heading towards 120 in Apple. I'm not here to make predictions. I'm here to say as long as we remain below a declining 5-day moving average and we have lower highs and lower lows, then it's guilty till proven innocent, and you let the market tell us where it's going to find support. We don't try to guess and where it's going to be. By the way, the year-to-date volume weighted average price in Apple is down at 119 right now. So let's take a look at oil for a moment. Oil is still below, or it's not below. It's right at that 50-day moving average. This is the 50-day moving average here. Now the direction of the 50-day moving average, that's what this blue arrow is for, is clearly still lower. And what I've done is outlined this prior resistance in here, basically between 48 and 49 really. This prior resistance has held as support for the last month, and that's encouraging to a degree, but we do see a lower high right here, and we break below this low and hold below it for a while. I still think it's I think it's very possible and likely that we will see oil drop back down towards $44 to $45 a barrel. All these green and red mean is this prior support has been acting as a resistance. This prior resistance has been acting as support, and this is potential for support once again. When we break it down further to an intraday time frame, this is a 4-hour chart, so each one of these candles represents 4 hours. You can see this is that band of support. We keep dipping down into it, and they bring it higher a little bit, but will the buyers give up in here and let go of it and let it come back down towards 44? Because the primary trend is still lower, I think that, as always, with any consolidation, they're more likely to continue in the direction of the primary trend than they are to reverse. So still be alert for lower prices in oil. The Biotechs, as we know, had another positive week. They broke past some important resistance here at about 341. So let's take a look at that on the 30-minute time frame. They broke above this 340 to 341 band of resistance. We've got a rising 5-day moving average. We pulled back today, but I think that, back below 340, that should get your attention. That would also kind of put it, back below this trend line as well, and that might bring about a little bit further profit taking. If we were to break below and hold below 340, then we're back to looking at about that 332 to 333 level initially for a downside target. But again, the primary trend is still higher, so if you're going to take short positions right now until we're proven otherwise, especially with the rising 5-day moving average, that they simply just don't make sense at this point. Bonds lost a lot of ground here this week, and let's just take a look at that once again here on the sheet. We saw that bonds for the week were down 4.6%. So we had seen a pretty powerful decline. It rallied up to the 50-day moving average, which is now flattening out. And what we saw in here is that we had seen a little bit of resistance taken out. It made higher highs and higher lows, and then it started to turn sideways and broke below the 5-day moving average. Lower highs and lower lows below that 5-day moving average again said if you bought over here, there was no reason to be involved on the long side any further. And now, we have the possibility actually that this could be considered point A. Let's just call it 138, and this could be considered point B at 126. So that's 12 points. If we took this point C at 130 and took 12 points off that, it would give us a downward objective measured move of 118. Now that may seem pretty aggressive here, but bonds are selling off, and that's definitely a possibility. It's not a call, but a possibility. We also have the 200-day moving average right here at about 120, and a lot of times we do find buyers in that area. So the key thing though is we're below a declining 5-day moving average with lower highs and lower lows. Therefore, it remains innocent, guilty till proven innocent. We spoke about Alibaba and what a piece of garbage this stock was, and it effectively put everyone who bought it after the IPO in a losing position for a day and a half, as it broke to new all-time lows for the since it's publicly traded, and it's below a declining 10, 20, and 50-day moving average. The 5-day moving average has been declining. It still is. Next week, if it can get back above this little band of resistance, 86 to 87, then perhaps it can bounce a little bit. So maybe it rallies up, pulls back, and then continues to go. But the odds simply do not favor further upside in this, not for the longer term. I mean, you can get rallies, but they're likely to fail because the primary trend is still lower. Same with GoPro. It's just a piece of garbage. It's lower highs and lower lows. We broke some support. That support was broken and continued to act as resistance in here this week. We got above the 5-day moving average once again. We talked about this last week, that we got above the 5-day moving average, but what's the direction of the 5-day moving average? The 5-day moving average is heading lower. Therefore, this stock remains on the intermediate term guilty till proven innocent. On the longer term time frame, still guilty till proven innocent. I would not be surprised at all to see it come back down here and make a new low since being publicly traded. I thought that maybe Baidu was looking vulnerable over here, and it got back above that 5-day moving average and then squeezed some shorts here. So if you had been short this, then the key, as always, is not just the trigger, but where does your risk management come into play? So let's say you did get short below last week's low. Once it got back above this lower high, that was your cue to cover and avoid taking that type of loss. The shares of level 3 were mentioned as a possible stock to be able to continue to move higher. It did, in fact, break some resistance. If you're long this stock, I would say, be real careful with it. Don't give it back to below maybe, break even at this point. MDLZ was one that I thought if it could get back above 37 and a dime, that it had the possibility to continue to move higher. And this is why, in particular, when the market is below a declining 5-day moving average, we don't do what we refer to as cheat buys. That is, buy early before a trigger. The stock never traded above that 37 and a dime this week. Here's the action this week. So it was a watch list idea. Now, had it broken out above 37.10, I would have purchased it with a stop right here. It never gave the buy signal, so there was no reason to be involved. There was no momentum. When you're buying, technically, you want to buy that short-term higher high and protect it with a stop underneath the most recent and relevant higher low. Well, that never occurred, so there's no reason to be involved. Tesla, finally, this one, again, I still think it's headed down towards probably the 180-ish level or so. It's below all of the volume-weighted average prices that are relevant. It's below all the trend lines. It's making lower highs and lower lows. It's a volatile stock, but it is heading down further. And this week we saw it briefly above the 5-day moving average, but again, what was the direction of the 5-day moving average? Do not expect that rallies like this will hold. They typically fail when the 5-day moving average is turning lower. If it found support in here like this and then turned higher and dragged that 5-day moving average with it, that would be a different story. But obviously that did not happen, so there was no reason obviously to be a buyer of Tesla, and it still looks like it's headed lower from here.